we sort of have been wading through very choppy waters anyway, and what sustained the latest rally up until this week was a lot of retail investors habitually buying a dip based on really very little context other than it's worked so far. But everything has changed since then, and some of those changes were obvious, but they weren't really noticed. Like, for example, the fact that the Fed has been talking about tapering. But since the taper, which hasn't really officially begun, yields have skyrocketed on part because people are running out of bonds, which is really sort of interesting, a completely different correlation than normal. Market gets spooked, people run to bonds, and that could change. But also, I think there's been a lot of shaking of the confidence of the Fed in general. And that's a possibility why people are running more towards raising those yields and out of bonds, because we have two members now admittedly trading that are retiring. We have Powell potentially not getting renominated, although that looks unlikely. And we have a real divide between the hawks and the doves in the Fed. So right now, with inflation out of control, that's all of that's one factor spooking the market. The other factor spooking the market, of course, is this debt ceiling situation, because we know that the Republicans have already said they're going to vote against any government spending. They're going to vote against the debt ceiling other than raising it enough to cover old expenses, which, of course, the government shutdown looming and then the possibility of default, whether it happens or not, it's spooking the market. Then you have oil and gas prices that have gone ballistic, and I think maybe gone up a little too fast. But nonetheless, they have gone up. Food prices have gone up. Consumer confidence has gone down. And then you add on top of that Evergrande, which people are still negating the idea of it being the Lehman Brothers moment. And certainly China has come out and said that they will support the real estate market, but they did not say they were going to support Evergrande, which has another bond payment coming up. That could still be a factor. So all of this has taken what was looking very interesting with small caps trying to play some catch up and turn it into more of a liquidity situation that we're seeing on Tuesday in the market. What we don't know, of course, is what's going to happen, even though the variant looks like it's plateauing. We're getting colder weather, so we don't know about that. That could be a factor. Number two is we don't know how the debt ceiling and the government shutdown is going to resolve. And number three is we don't know what the Fed is going to do, because they have this quandary about inflation potentially being less transitory than they thought, although they're still holding on to that. And the economy and the market crashing, and we still have a low labor force. And now we have all these situations where the supply chain has gotten so tight, it's going to take a while for that cycle to go through. So I think there'll be pockets of the market, but I always like to say very simply, look at two areas. Look at transportation, because that tells you everything. It tells you everything you need to know about the economy. Is demand going up or down? Are trucks moving? Are railroads moving? Are people flying? Right now, people are flying a little bit more, but yeah, we still have restrictions about where these people in the United States can go. And in Europe, there are a whole other host of problems with supply chain and oil and gas. Consumer demand being down. I mean, transportation has to hang tough. Otherwise, that's a bad sign. And the other is the junk bonds, because they have been now for the last, well, pretty much since the crash in March 2020, doing nothing but going up as risk on was the key. People buying junk companies with high yield, and now they're starting to reverse. And if they start to go down, we're in trouble. So it's going to be really interesting here the next couple months. And I don't know if it has anything to do with it being September, October. You might as well say Mercury's in retrograde. But you know, I don't really like to trade off of cliche. But nonetheless, the timing is interesting, because we've kind of been in this very false inflated equity valuation based on all this easy money. And that's really what people, I think, are going to be watching is the easy money going to go away or not? No. No, and I'll tell you why. There really isn't anything wrong with the supply. The U.S. has tremendous amount of oil reserves. We're seeing more problems in Europe right now, and a lot of that, again, is not because of supply. It's because of supply chain. They had to have the military actually come in and make sure that people were getting gas at the petrol stations in an orderly fashion. That's where you get the hoarding mentality, where people psychologically get really afraid, like what happened with toilet paper last year. So essentially, we have to look at the difference between is there physical oil? Yes. Is there a supply chain problem? Yes. So at what point does either the supply chain problem subside or more oil gets released into the market, and then that actually will start to put a little bit of a drain on the oil market? Plus demand, again, people are still, if we have any kind of issues this winter, let's say, and oil continues to go up and people start to stay home more, then of course that would also be a self-fulfilling prophecy where oil will come down because demand will start going down. So I would not chase oil up here at all. I think you had to be in anticipation of this happening. And at this point now, even today, Tuesday, oil just went from green to red. Natural gas just went from green to red because you're going to see liquidation. If the market crashes, there's going to be liquidation everywhere. Even the banking sector, yes. Even the banking sector, because the banking sector has gone up, obviously with the yields going up. But then again, you have to say how much more will the Fed allow yields to go up? They'll risk the inflation again because they cannot, especially Powell and Yellen, cannot afford to be coming into midterm elections the people that crash the market and crash the economy. The one thing we could say is that you've got about as much bad news as you can think of right now coming out of governments. And this is government bad news. China, government. U.S. regulations, government. And yet Bitcoin is holding 40,000 right now. So that's very key support because there's still a lot of reasons to be bullish in the cryptocurrency space, particularly blockchain technology, which I was reading yesterday could really help with energy as well. So the idea of cryptocurrency showing now that it's more speculative in a sense, following the stock market, makes a little sense here. But if it holds 40,000 and the market continues to go down, people might go, you know what? It's still not a bad place, a bad hedge for inflation or fiat currency, which of course the dollar has skyrocketed as well into all of this. But for how long? It'll really be whether or not people who are like Michael Saylor so bullish, keep continuing to buy Bitcoins, the other coins also continuing, some of them to sit at really good support, outweighs the government scariness that's happening. Can they really regulate it? And even if China bans it, does that mean that there aren't going to be tremendous workarounds without China being involved in cryptocurrency?